Hey everyone, welcome to our video on stock market indices. In this video, we are going to explain what stock market indices are in a very simple and easy way. There are four of us in this presentation and I will start with a quick introduction. So, what exactly is a stock market index? A stock market index shows how a group of selected shares is performing in the stock market. These shares usually belong to well known and important companies. The index gives us an overall idea of what is happening in the stock market at a particular time, and the value of the index is shown in numbers. When the index number goes up, it means that more share prices in the market are increasing. When the index number goes down, it means that more share prices in the market are decreasing. So, instead of checking the share prices of many companies one by one, we can simply look at the stock market index to understand whether the market is moving up or moving down. Let's understand this with a simple example. If the share prices of major companies increase, the index value also increases. If the share prices of major companies decrease, the index value also decreases. This shows that a stock market index reflects the movement of entire market and not the performance of just one single company. So, this was a simple introduction to stock market indices.
Now we are going to discuss about features of stock market indices. Under that, first one is made up of selected major companies representing the market. Stock market indices include well-known and financially strong companies from different sectors. Example, Nifty 50 includes 50 large companies like Reliance, TCS and HDFC Bank. And the second one, value changes daily based on share price movements. The index value increases or decreases every day depending on the rise or fall in share prices of its companies. Example, if most Nifty 50 shares rise today, the Nifty index will also go up. And the third one, reflect overall market trends and performance. Indices shows whether the market is bullish or bearish. Bullish means rising and bearish means falling. Example, a continuous rise in Sensex shows positive market sentiment. Fourth one, calculated using a specific method, price weighted or market cap based. Indices are calculated using formulas to give proper weight to companies. Example, Sensex uses the free float market capitalization method. Fifth one represents a particular market, sector, or economy. Different indices represent different sectors or countries. Example, Bank Nifty represents banking stocks, while Nifty 50 represents India's broader market. Sixth one, widely published and updated in real time. Index values are continuously updated during the market hours and available to everyone. Example, Sensex values are shown live on financial news channels and stock apps. And then now we are going to discuss about importance of stock market indices. Another first one helps investor understand the direction of the market. Indices help investor know whether the market is moving up or down. Example, if Nifty is falling for many days, investors may avoid risky investments. And the second one, used as a benchmark to compare investment performance. Investors compare their returns with index performance. If a mutual fund gives 10% return while Nifty gives 12%, the fund is underperformed. And the third one indicates the overall economic and financial condition. A rising index generally shows economic growth, while a falling index shows slowdown. During economic crisis, indices usually fall sharply. And fourth one, assist investors in making informed investment decision. Indices help investors decide when to invest or exit the market. Investors may invest more when indices show steady growth. Helps government and analysts study the market behavior. Policymakers use indices to analyze financial stability and investor confidence. Government reviews Sensex movements before announcing economic policies. Sixth one, useful for tracking long-term market growth. Indices help measure market growth over many years. Example, comparing Sensex values over 10 years shows how the Indian stock market has grown.
Now, Let me take you to the final and one of the most important parts, the Indian stock market and its indices. In this final segment, I will be explaining what BSE and NSE are and how Sensex and Nifty 50 help us understand the overall mood and direction of the market. First, let's talk about BSE, Bombay Stock Exchange. BSE is India's oldest stock exchange. It was established in 1875, which makes it one of the oldest stock exchanges in Asia as well. Think of BSE as a marketplace, but instead of buying vegetables or clothes, people buy and sell shares of companies here. When large companies list their shares on BSE, investors can trade those shares. The performance of BSE is measured by something called the Sensex. Now, let's understand NSE, National Stock Exchange. NSE is India's largest stock exchange. It is known for introducing electronic trading in India, which made share trading faster, more transparent, and more efficient. Just like BSE, NSE is also a platform where shares are bought and sold. The main index of NSE is called Nifty 50. Here are the two important stock market indices. The first one is the BSE Sensex. Sensex represents 30 well established and financially strong companies from different sectors listed on BSE. These 30 companies are chosen carefully because they represent the overall health of the Indian economy. So, when the share prices of these companies go up, the Sensex goes up. When their prices fall, the Sensex falls. That means Sensex shows the overall mood of the market, whether investors are confident or fearful. The next one is Nifty 50. Nifty 50 represents 50 large and actively traded companies from different sectors listed on NSE. Since it includes 50 companies, it gives a broader picture of the Indian stock market compared to Sensex. When most of these 50 companies perform well, Nifty goes up, and if they perform poorly, Nifty goes down. So, Nifty 50 reflects the overall direction and strength of the Indian stock market.
What if I told you the world economy as a heartbeat and stock markets are the pulse? Every day, billions of people watch global stock indices to understand whether the world is growing or slowing down. These indices are not just numbers, they are the emotions of money reacting to news, innovation, and global events. Let's start with the United States, the financial powerhouse of the world. Your stock markets track giant companies from technology, banking, healthcare, and manufacturing. When American tech firms perform well, confidence spreads across the globe within hours. Asia reacts first and Europe follow next. This is why a good or bad day in US can change markets worldwide. Now let's move to Europe. European markets reflect global trade, exports, factories, and banking strength. When international demand rises, European stock rises too. But when wars, inflation, or recession happen, Europe often feels the impact quickly. It's like Europe is the yearly warning system of the global economy. Next comes Asia, home to some of the fastest growing economics. Countries like Japan, China, and India play huge roles in manufacturing, exports, and technology. A new government policy, factory boom, or tech breakthrough, you can lift markets within minutes. Then we have resource rich countries like Australia, Canada, and Brazil. Their stock markets move with oil, gold, metals, and agriculture prices. When commodity prices rise, these economies grow faster, and when prices fall, markets slide. Here is the most interesting part, all these markets are connected like dominoes. A crash in one country can trigger panic across continents in hours. A boom in technology in one region can create wealth across the world. This proves one thing clearly, the world is no longer separate economics. It is one giant financial system. When indices fall, fear spreads. When they rise, hope grows. So the next time you see stock market numbers on TV, remember you are not just watching prices, you are watching the world economy breathe, react, and move in real time. Understanding the global stock markets help us see how the world economy moves every day. Hope this video made finance simple, interesting and meaningful for you.
Thank you everyone for patiently listening to our presentation.